Assignment number 8 deals entirely with the concept of depreciation. In the agricultural world and in most business firms, whenever you buy a piece of equipment, it eventually wears out. Equipment like trucks, tractors, hay balers, things like that. Over time they will wear out and you have to buy a new one. It also goes for improvements to property such as barns, fences, sheds, things of that nature. Eventually all of those particular assets wear out over time and you have to replace them. Well, this brings in the concept of depreciation. Depreciation is a non-cash expense that is recorded on your profit and loss statement on your income statement. And what it is although it's not actually a cash expense, you're not actually paying cash for the loss of that equipment because it's wearing out. On your income statement, you can actually report that as a cost, thus lowering your taxes. So, the concept of depreciation can be very important whenever it comes to filing your income tax. And the federal government sees this depreciation as a cost because as that piece of equipment wears down, it is actually costing the firm money. Let's say, for example, you have hypothetically a $30,000 vehicle that is wearing out over time. Yes, it may not you might have already paid for that vehicle and it's completely paid off, but over time it is costing you money to run that vehicle because you will eventually have to replace it. The depreciation is the cost associated with the vehicle wearing down. So, being able to calculate depreciation becomes very important for the income statement. And there are two main ways of calculating depreciation. The first one is straight line. The second one is double declining depreciation. Now, within Google Sheets, you can use the depreciation functions. Just like in assignment number 6, we use the payment function to calculate payment for those loans. Well, you can do the same thing with depreciation functions. But for this particular assignment, we do not want you to actually use those functions. We want you to calculate depreciation out by hand. Now, when we say by hand, we don't want you to actually go in there and write it out and then just plug numbers in. We want you to use the formulas or use formulas to calculate it all in Google Sheets without using a built-in depreciation formula. So let's go ahead and get started with the simplistic way of calculating depreciation, and that is straight line depreciation. Straight line depreciation means that you will have a piece of equipment that has so many years of a useful life, and over each year that piece of equipment will depreciate by the same amount. Thus it is straight line. It doesn't increase, it doesn't decrease, it depreciates by the same amount each year. Well, let's go ahead and say we're going to give you an asset that's, whenever you bought it, was worth $25,000. Now let's say, for example, that piece of equipment might be a fence line, and that fence line has a useful life of 10 years and has a salvage value of $0. At the end of those 10 years, you're going to rip that fence out and you're not going to receive any money in salvage value for it. So let's go ahead and calculate straight line depreciation on this particular asset. So, in order to calculate straight line depreciation, first off we have to calculate this annual depreciation. The annual depreciation is this formula right here. It's the purchase price minus the salvage value divided by the useful life. So in order to calculate that, you say equals, open parenthesis, this purchase price minus the salvage value divided by this useful life. So we can see that over the course of those 10 years, that particular asset will be depreciated by $2,500 each year. So let's go ahead and calculate the straight line rate as well. In order to calculate the straight line rate, you say equals, you do this depreciation divided by the purchase price minus the salvage value. Now, as you can see here, if we look at this particular formula, I have the purchase price minus the salvage value in parentheses. And as we look at the annual depreciation, you see that I have B1 minus B2, or the purchase price minus salvage value in parentheses. For this particular assignment, you're definitely going to want to watch where you're putting your parentheses and make sure you're conforming to the order of operations in order to make your numbers come out appropriately. Because if you didn't put those parentheses in, it would actually take 0 divided by 10, so that would be 0, and it would be $25,000 minus 0. So instead of it coming out to $2,500, it would come out $25,000. So make sure you're watching where you're putting the parentheses. So we're going to go ahead and say the beginning book value is equal to the purchase price for this first year. And as you can see, I have this table set up where I have the year and then the number of years of useful life. So whenever you set up this table, you definitely want to make sure that this ending number is equal to the number right here, that number of years of useful life. The annual depreciation is going to be equal to this value that we calculated, and I'm going to go ahead and lock that in because it's going to be the same annual depreciation year after year. So at the end of that first year, that ending book value is going to be equal to the beginning book value minus the value in which it depreciated. So then that beginning book value of the second year is going to be the ending book value of the previous year. Now remember, these are years. So we could actually say this was you bought the asset in, say, 2014. So the second year is 2015. The third year is 2016, and so on and so forth. Or you can keep it as just 1 through 10. I would say keep it as 1 through 10 on the assignments, except for assignment or problem number 7, because it's actually asking you to plug in the years. But just know that you can substitute years in for the numbers. So I'm going to leave them in here for right now. And we're going to say that at the beginning of 2014, that book value was equal to $25,000. In 2015, that book value was equal to $2,500 or $22,500. So then in that second year, now that it's only worth $22,500, we are going to actually depreciate that asset again. So it is worth $22,500 at the beginning of, say, 2015. That annual depreciation is going to stay the same in straight line. So then we can just simply drag that particular value down. Now we can go ahead and say equals beginning book value minus the annual depreciation to come up with the ending book value for 2015, or that second year. Again, the beginning of the third year, or 2016, is going to be equal to that value. Well, once you have this second line calculated, just like we did in the loans, you can actually drag this all the way down. So as we look, it depreciates by the same amount every single year, and the thing to note is that you have a 0 at the end. This will not always equal 0 on all of your assignments, but it should equal your salvage value. At the end of the useful life, the ending book value will equal that salvage value. So we're going to go ahead and change these all back to just number 1 through 10, just to kind of be able to see that a little bit more. And at the end of that 10th year, the end of that useful life, this ending book value better equal the salvage value. Now, let's say, for example, we're going to go ahead and delete all this again and show you another example where the salvage value is no longer equal to 0, but say it's equal to, let's say, $2,000. So now we see that this is already adjusted, this automatically adjusted to match the salvage value because we have it cell referenced properly. So we say the beginning book value is equal to that purchase price. That annual depreciation is equal to this annual depreciation that we're calculating. We're going to lock in that cell because it doesn't change from year to year. This ending book value is going to be equal to the beginning book value minus this annual depreciation. And the beginning book value of the next year is equal to the ending book value of that year. So then we can go ahead and take these two cells, drag them down, highlight all three of these, and drag it down just like we would before. And as you can see, at the end of that useful life, at the end of those 10 years, the ending book value equals this salvage value right here. These two numbers have better equal at the very end of it. So that's essentially how you do straight line depreciation. Let's go ahead and look at double declining. So what we're going to do is now we have a asset that was purchased at a price of $67,000. Let's say this is a nicer 3/4 or 1-ton truck. And then we have the salvage value of $7,000. So basically what it's saying, at the end of 5 years, that truck on its book value is only going to be worth $7,000. And we're going to do this using the double declining method. So we're going to go ahead and calculate the annual depreciation in the same way. So annual depreciation is equal to the purchase price minus the salvage value divided by the useful life. And we have that formula written right there. Now let's go ahead and calculate the straight line rate. So that is equal to the annual depreciation divided by the purchase price minus the salvage value. So now we have this straight line depreciation. Well, double declining rate, so this is a straight line rate. So if we were to do this using straight line depreciation, we would actually use this rate right here. But because we already calculated the annual depreciation on straight line, it becomes almost irrelevant, but it's still necessary to calculate it for your assignment. Now, whenever you are using the double declining, this straight line becomes a lot more important. So in order to calculate the double declining rate, you take the straight line times 2. The straight line rate times 2. And what that is the rate at which you're depreciating the asset. So before we are depreciating the asset at basically the same value every single year. Now we are going to double that depreciation in the beginning, and then actually you'll see that the depreciation is a lot higher in the beginning of the asset, in the beginning of the depreciation cycle, and a lot less at the lower. So let's go ahead and start this off. We're going to go ahead and say the beginning book value is the purchase price. The annual depreciation for double declining is equal to this beginning book value times this double declining rate. We're going to go ahead and lock in that double declining rate. You can see I locked it in by putting those by pressing F4 and throwing up those dollar signs. So the ending book value here is equal to this 67,000 minus this value right here. So then your beginning book value for the next year is equal to your ending book value there. So then we're going to go ahead and drag this down. And we're going to drag this one down as well, because we already have all your formulas in there. Then we highlight these three and we drag it all the way down. Now as you can see, your annual depreciation begins to decline over the years on double declining versus straight line. On straight line, it remained the same over the useful life. The main difference between the two is, let's say you've got a piece of equipment such as a truck. The truck will probably depreciate faster in the beginning of the purchase or in the beginning of the life of the vehicle than it will later on. And that can often be said by whenever you drive a vehicle off the lot, you buy a brand new vehicle, you drive it off the lot, it automatically loses half of its value that particular time. That old saying is a tried and true meaning of what double declining is. It declines faster, that particular vehicle, the value of it declines faster in the beginning than when it does at the end. Let's say, for example, you've got a $40,000 truck, you drive it off the lot, you drive it for a year. That truck, if you look up the book value, might only be worth, let's say, $25,000 at the end of year 1. And at the end of year 2, that particular truck's now worth $15,000. Year 3, that truck's now worth $10,000. Year 4, it's worth $5,000. And then after that, that particular truck stays at $5,000 after that. That's that salvage value. But it depreciates a lot faster in the beginning than what it does in the end, just simply because it's wearing down faster. So annual depreciation, you might use double declining on equipment that wears down a lot in the beginning and not so much at the end, such as trucks and tractors and things of that nature. Whereas you might use straight line on it, say a fence that wears out at more or less a constant rate. So the thing to note is that you can never depreciate an asset past the salvage value. So we said that the salvage value is $7,000 up here. But if we look right here, by the end of year 5, that ending book value is now below $7,000. If that ever occurs, you have to manually adjust this. So pretty much on all of your double declining problems, you're going to have to go in and manually adjust these numbers. So this ending book value needs to equal 7,000. But this annual depreciation has to match to where it's the beginning book value minus the annual depreciation equals this 7,000. So the best way to do that is, I'm going to go ahead and go back, and we had the formula in there and we were saying that we were depreciating it out to $5,000. Well, we can't depreciate below the salvage value. So you can come in right here and say this is equal to this cell, or you can just type in 7,000. This might be the only time that I allow you to type in a number down here rather than just using a formula. But it might be easier to just say it's equal to the salvage value. So then what you need to do is you need to adjust this to where the difference between this and the beginning book value and the annual depreciation equals this ending book value. So in order to do that, you will simply come in here and say equals beginning book value minus ending book value. And now you can see that the beginning book value minus the annual depreciation is going to equal $7,000. So in this particular example, you had a $65,000 piece of, say, a truck. And in the first year, you depreciated off of your taxes $26,800. That cuts back on your tax bill that first year. The second year, you depreciated only, say, $16,000. Third year, you depreciate $9,000. The fourth year, you depreciate almost $6,000. And the fifth year, you depreciate about $1,600. And the reason for this is it might be an asset that wears down faster in the beginning and not quite as fast at the end. And also you can decide whether or not you want to use double declining or straight line based off of, say, tax reasons. Maybe you want to depreciate the asset faster in the beginning to knock a lot more of, or knock your tax bill a little bit further down in the beginning rather than the end for different tax strategies. So that's the main difference between double declining and straight line, is that assets that wear down faster at the beginning, you often use double declining. Assets that wear down about the same throughout the course of its life, you might use straight line. So let's go ahead and go through one more quick example where we're going to compare straight line to double declining side by side. So let's go ahead and do straight line. Well, first off, let's find out these three values up here, these three constants. So we're going to do annual depreciation is equal to the purchase price minus the salvage value divided by the useful life. So then we're going to come down here and the straight line rate is equal to the annual depreciation divided by the purchase price minus the salvage value. Now be sure whenever you're doing this to go ahead and make sure that you have your parentheses where they need to be. So then we're going to go ahead and calculate double declining rate. So remember that this double declining rate is equal to your straight line rate times 2. So we're going to say equals this times 2. So now that we have all these filled out, we're going to go ahead and do the straight line table first. Straight line, if you remember, is equal to the beginning book value is equal to the purchase price. The annual depreciation is equal to this annual depreciation right here. We're going to lock that in because that doesn't change. The ending book value is equal to the beginning book value minus the annual depreciation. This beginning book value of the second year is equal to the ending book value of the previous year. You could take these two cells and drag it down because the formula is already there. Take all three cells, you drag it all the way down to the bottom, and we can see that we have a useful life of 10 years. So we see that we go down to 10 years. And the ending book value is equal to 20,000, which is the salvage value. Remember, you can never depreciate further than the salvage value. So let's go ahead and look at what does it look like in a double declining rate. We're going to compare them side by side. Same parameters, just one's going straight line, one's going double declining. So we go ahead and enter in the beginning book value. Annual depreciation is going to be beginning book value times double declining rate for the double declining depreciation. We're going to lock in that double declining rate because it does not change. Ending book value is equal to the beginning book value minus the annual depreciation. So then we're going to go ahead and say the next year is equal to the ending book value of the previous year. We're going to drag these two down. Then we're going to go ahead and drag these three all the way down, right? Just like we had before. Now if we look, the salvage value is equal to 20,000. And right here we're still above 20,000, but in year 8 we actually fall below $20,000. Remember, your salvage value can never fall below 20,000, or the ending book value can never fall below 20,000, or the salvage value. So what you need to do is, whenever you're doing double declining, is go ahead and look through here and make sure that none of these particular cells go below the salvage value. And the first time it does, what you need to do is you need to take, so in this case row 8, year 8, and you say equals that salvage value. As soon as it falls below that salvage value on one particular year, you need to take that ending book value and equal it to the salvage value, because it cannot fall below the salvage value. Now, just like we've done before, you need to say, all right, this annual depreciation on year 8, which is the first year that it fell below that salvage value, you need to say equals beginning book value minus the ending book value to figure out how much is going to be depreciated that year. Now, that is the last amount of depreciation. We've already depreciated the asset out to 20,000. We cannot depreciate out anymore. So in year 9, we're going to have 0 depreciation. In year 10, we're also going to have 0 depreciation. So you can see that in year 8, year 9, and year 10, the ending book value is equal to 20,000. Now, if you were doing this for your income tax and you wanted to continue to depreciate this out over the course of those 3 years, a lot of times what will happen is you'll take an operation, you might double decline it down to say year 5, and then after year 5 where you have a total depreciation left of say 8,192, transfer that into straight line and actually depreciate that over the last 5 years. So then after that, each year you'd be depreciating say $1,000 each. We don't want to get into that kind of stuff at this time. We just want you to know exactly what does it mean for straight line and what does it mean to double decline rate, and know how to calculate both. Now the next thing I want to do is I want to look at both of these. We see that the annual depreciation, it depreciates by $8,000 each year. This is the same piece of property, or the same asset, and you can see on this side it's actually declining at up here it's declining at a lot faster rate until it hits about right here, and then it starts declining at a lower rate than the annual depreciation, meaning that, or on the straight line depreciation, meaning that we decline this asset faster in the beginning and slower at the end. And that becomes very evident whenever we talk about the first 5 years of depreciation versus the last 10 years, or the all 10 years. So what we're going to do is we're going to calculate how much depreciation accumulated over the first 5 years in straight line depreciation and in double declining. So in order to do that, I'm going to say equals sum, and I'm going to highlight the first 5 years. So we do 1, 2, 3, 4, 5 years. So we see that in the first 5 years under straight line, we depreciated $40,000 of the asset. Under double declining, we're going to add up those first 5 years again, and I'm just simply using the equals sum formula. The equals sum formula is just a way to add up everything within the highlighted box. So I'm going to highlight these first 5 years of depreciation under double declining. So we're just basically adding up these 5 boxes using that equals sum function. So what we can see is that under the first 5 years, under straight line, you only depreciated $40,000, whereas under double declining, you depreciate $67,000. You depreciate a lot more in the first 5 years. Now let's actually look at second 5 years. And we're going to do the same thing, equals sum, but we're going to do the last 5 years. So we're doing 1, 2, 3, 4, 5. And we're going to do that again under the double declining, equals sum. We're going to do 1, 2, 3, 4, 5. And as you can see, under the double declining, in the last 5 years, the second 5 years, the depreciation, we only depreciate $12,000 versus under straight line we depreciate $40,000. So we obviously can see that we depreciate a lot more in the first 5 years under double declining than in the second 5 years. Well, what happens under the depreciation of the entire 10 years? So we're going to say sum, going to add up all of these. We're going to come over here and we're going to say sum, and we're going to add up all of the depreciation values under the double declining method. And we see that they come out to be exactly the same. Well, why is that? Well, the total depreciation of an asset will be equal to the purchase price minus the salvage value, regardless of whatever method you use. So whether you're using straight line or double declining, these two values had better equal each other in order to be right. But under the double declining, what you can see is that the asset depreciates a lot faster in the beginning, a lot slower in the end, and that allows you to make some management decisions when it comes to actually the tax. And remember that depreciation is a non-tax expense that is recognized by the federal government on your income taxes. You may not actually make that expense, but you are incurring it through the loss of that equipment over the length of the useful life of it. So hopefully this little video will help you out on assignment number 8 and also shed some light on the difference between what depreciation is and the difference between double declining and straight line depreciation.